You know, I talked about animal spirits before and immediately after the election, and we've seen it in spades from the business sector. The jobs report also been pretty strong. Employment, not only strong, but good paying jobs, construction, mining, a couple of areas, along with mining that I think should continue to be major winners from the Trump administration's removal of those overbearing regulations. Now, this is all starting to create a perfect storm for the housing market, which has suffered from backlash associated with things like Dodd-Frank and more recently a dearth of supply for would-be buyers. Now, judging from today's housing market index, new homes are going to be in big-time demand. The HMI soared to a reading of 78 now. That's the highest since July of 2005. It was driven by traffic. After contracting for more than 11 years, it's been positive now in 3 of the last 4 months. That news, coupled with buyers looking for opportunity after a slight pullback, put a bid under the market when we opened for this session this morning. But it was the Federal Reserve, Janet Yellen, who added that oomph to today's trading. Yeah, the Fed hiked rates 25 basis points. Everyone expected that, but they also removed speculation that for the remainder of the year, they're going to commit to just 2 additional rate hikes. Ironically, Yellen seemed reluctant to make too many positive assumptions about Donald Trump's economic agenda and its potential impact on the economy. So the Fed right now is saying they only see GDP growth for this year at 2.1%, next year at 2.1%. Still, the market got even stronger as Yellen talked about the committee carefully monitoring actual and expected inflation developments related to its symmetric inflation goal. The stock market finished near the highs of the session. The S&P 500 was the biggest winner. The large indices all did well, but the Dow was weighed down by softness in Goldman Sachs. I also think the most compelling action today happened in the bond market. The 10-year yield plunged almost 4% on the day. Here to help us hash it all out, Jon Hilsenrath. Jon, thanks for joining the show. It seemed to be a couple of surprises today, particularly the Fed going out of their way to sort of say, hey, there's only going to be 2 more rate hikes this year?
Yeah. You know, I think the market was very pleased that the Fed didn't come out of this meeting more hawkish than expected. You know, there were a lot of Fed policymakers in the last couple of weeks who were beating a drum about wanting to raise interest rates at this meeting. I think the market came to expect, hey, maybe something has changed in their view of the world. What Janet Yellen did today was give a very steady-as-she-goes presentation. They'll raise rates today. They're going to do 2 more this year. And that's basically what the market wanted to hear, and stocks rallied and bond yields came down as a result of it.
From what I've read in the last couple of statements, it feels like there may be some members of the FOMC who believe that Donald Trump's agenda or his policies will have an impact on the economy, and some aren't sure. Officially, where does the Fed stand? Because 2.1% growth next year doesn't seem to jibe with the idea of a removal of regulatory hurdles and lower taxes.
Well, I don't think the Fed... I think most officials acknowledge they don't know how things are going to play out. There's a possibility that, you know, we're going to get tax cuts, that there's going to be infrastructure spending, defense spending, regulatory overhaul. There's a possibility we get more growth, but they just don't know at this point, so they're holding their fire on that.
Jon, one of the concerns is that the Fed may be thinking that they don't want to get too far behind the curve, would be too aggressive. And then this comment about symmetric inflation, what does that mean in layman's terms? I mean, is the Fed saying that they won't put up too many speed bumps in this recovery?
Well, they put this word, as you say, symmetric into their policy statement. So what does that mean? This is what it means. For the last 4 years, inflation has been running below their goal of 2%. They've been undershooting their inflation goal. What symmetric means is that, you know, they'll be comfortable with the Fed running a little bit, with inflation running a little bit below the goal for a little while. They'll also be comfortable with inflation running a little bit above the goal for a little while, as long as in the long run it revolves around 2%. I think that's another thing that might have pleased stock investors, that, you know, Yellen was saying, listen, we're not going to really jack up rates very aggressively if inflation goes over 2% for a little while. We're taking this on a very steady course.
You know, I think that's not no music to the ears of Wall Street, but maybe Main Street as well, saying, hey, let's get the party started before we shut it down. Jon Hilsenrath, thank you very much.
Thank you.